It's not fair at all. Everybody compares their age because like what there's no other age. Yeah. Yeah, you still win. So like, okay, so.
Okay. Folks. Okay, I'm going to start the class with a couple of questions. First, how many of you are not in a group yet? Okay, I want you to keep your hands up because you can check around the room. There aren't that many people. So one of the things you might consider doing after the class is kind of getting together and seeing. So if you're not in a group, one of the things is hang out after class, see if you can create a group. Now, I did send out the orphan list last week, so I know that there are at least 6, 7 names on it. My only request, if you're on the Zoom, please mute yourself. Okay. My only request is that if you get adopted from the orphan list, take your name off the list so that at least have a sense of who's left. Okay, so now comes the follow-up question. How many of you have not picked a company yet? Okay. I'd expect most of you have not picked a company, but this is a question I will ask every session at least until the 3rd week. And by the 3rd week, I want everybody to have picked a company. Okay. Don't play Hamlet here. Right? I'm saying I can't make up my mind. I mean, just pick a damn company. You can always change your mind later. Right? It's better to have a company that you can track through the class. And then in the 5th or 6th weeks, I don't want. Just curious, anybody planning to value Spotify this semester? You're trying to be planning about. I want to ask you this question. But remember we talked about bias the last class. Do you think it's possible to value Spotify if you have a point of view on Joe Rogan? I'm not saying either direction. You know, when you value Spotify, do you think what you think about the Joe Rogan show is going to affect your valuation? Absolutely, in both directions. That's bias, right? It is what it is. I'm not saying it's good or bad. And that's what I mean about bias. We try to avoid it, but you can't get away from it. You're surrounded by things that add or take away from that bias. Everything you know about the company is going to enter the valuation. Okay? Any questions before we start? Logistical questions, group questions, project questions? Go ahead. Yeah.
So how would you look at, like, I know Joe Rogan came out that he's trying to be better, but how do you look at like the uncertainty of, you know, artists like Bob Dylan already asking to take his songs off Spotify? So how, like, the uncertainty, you know, what other artists they can drop out, how that affects stuff?
Do you think Spotify knows the answer to that question? No, I'm serious. No. It's a question that we all have, right? Nobody knows the answer. And that's why I said what you think about Joe Rogan is going to affect evaluation. So if you don't like the Joe Rogan show, guess what you're going to estimate? They're going to lose 50% of the music because this is going to be the end of the world. If you love Joe Rogan, you're going to say, you know what? People are, the people who are going to leave are going to be people who are at the margin, not creating that much in terms of an impact. That's where bias is going to show up, because none of us in this room, and none of the people outside, including the people at Spotify, know the answer to that question. But you can't value Spotify without taking a point of view on that. And I don't think you can do it without bringing some bias into the game. Right? Yes. I'm not saying in either direction. I'm saying there are going to, so if you feel that the Joe Rogan show is a good show, you might conclude that this is going to be very marginal, the impact is, whereas if you don't like Joe Rogan to begin with, nothing to do with Spotify, then that's going to impact how much music. So I'm saying this is not some objective assessment. It's an assessment that's going to be driven by the point of view you're going to bring in the company. I don't have a point of view. I'm just saying whatever your point of view is, it's going to find a way into your valuation. Don't fight it. Don't view it as a bad thing. It is what it is. Okay, so let's start today's class with a test. Now, during the course of today's class, I'm going to talk about, we're going to start to get into the details of discounted cash flow valuation. And I'm going to argue that if I gave you a business to value, there are one of two ways you can approach valuation. Remember, there are two ways you can fund a business. You can borrow the money or you can raise equity, and often you use both. The first way, you focus on just the equity investors in a business. You look at the cash flows that equity investors. You focus on the cash flows equity investors get out of that business, which is cash flows left over after debt payments, after reinvestment. So think of that as cash flows to equity. And you discount those cash flows back at a rate of return that equity investors demand for investing equity, which is going to be a cost of equity. So everything's equity focused. Cash flows to equity, cost of equity, what you get as a present value is the value of equity. In fact, if you take a very strict view of cash flows to equity, there's only one cash flow you as an equity investor get from the company, right? What's that cash flow? Dividends. Everything else is kind of estimated, might be delusional. The dividend discount model, which is the oldest discounted cash flow model around, is an equity valuation model. You take dividends, because those are the cash flows, you discount them back at the cost of equity, you get a value of equity. We're going to argue that the dividend discount model is probably too rigid. We'll talk about why, but that's the first approach. Focus on equity, get cash flows, discount back at the cost of equity. The second way you can approach valuation is to look at the entire business. What does that mean? Instead of focusing on the cash flows just to equity investors, look at the collective cash flow that both equity investors and lenders get from the firm. What do equity investors get? They get the cash flow to equity. But if you're a lender to the firm, do you get cash flows from the firm as well? You get interest payments, and if principal is repaid, you get principal repaid. You get cash flows as well. That collective cash flow you get is called the cash flow to the firm. It's a pre-debt cash flow, because debt is no longer an outsider in the game. They're now suppliers of capital. That's a collective cash flow to the firm. If that is the cash flow you're discounting, you have to be consistent. In what sense? Since you're looking at both cash flows to equity and debt, the discount rate you apply has to be a weighted average of what equity investors demand, which is the cost of equity, and what lenders demand, which is the cost of debt. You know what we call that, right? In foundations or corporate finance or whatever that class is called. What's that weighted average called? Oh, please don't call it the WACC. Let's call it the cost of capital. WACC sounds so crude, but it is a weighted average cost of capital, right? If you're looking at the cash flows to the firm, the discount rate you apply has to be the cost of capital. And what you will get as a present value, will be the value of the entire business. But let's say you're still interested in just the equity. You know how you get there? You value the whole business at $1 billion. If you owe 400 million, you have 400 million debt, you subtract out the debt, you get the value for the equity. So there are two ways you can value equity. One is by taking cash flows to equity and discounting the cost of equity, coming up with the value of equity. Or you can value the whole business by taking cash flows to the entire firm, discounting back at the cost of capital. And I'm going to show you in today's class that if you do it right, you will get the same value for the equity using both approaches. But here's what you cannot do. You cannot mix and match. You know what I mean by mix and match? You can't take cash flows to equity and discount at the cost of capital. You can't take cash flows to firm and discount at the cost of equity. What you will get is complete and total junk. So I'm going to start with a very simple experiment today. This is actually from an actual valuation that was done in the late 70s. A company called Kennecott, a copper mining company, was forced to divest itself of a coal subsidiary by the antitrust people. So this was a $3 billion company. They sold off the coal subsidiary. They got $600 million in cash. And for the company, this created an immediate problem. What's the problem of having a lot of cash? You're a small company with a lot of cash. What are you afraid might happen to you? It's the danger of having a lot of cash as a small company. No, there's not. I mean, the SEC has no control over cash. Thank God for that. That's the last thing you want to give them. So thank God they don't have that regulatory power. Yeah, but you know, let's make the danger real. You're underutilizing your resources, but you have no projects. You have 600 million in cash. You know what they're afraid would happen to them? That somebody would take them over, using their cash to essentially fund a big chunk of the acquisition. You have 600 million in cash that you have no use for as a company. What's the most logical way to get rid of the cash? Let's start with the most logical way. What's the most logical way? You don't have a use for the cash. You're a publicly traded company. What should you do? Well, if they did, they would take it. But the investments are not there. You don't have a use for the cash. Give it back, right? Whether you pay a dividend, buy back stock, that thought never even crossed Kennecott's mind, because what would shareholders do with stupid things like pay off the mortgage, buy a car? You know, you can't have that happen. So let me ask you a follow-up question. What's the stupidest way to get rid of 600 million cash if you're in a hurry? You do a big acquisition. And that's exactly what Kennecott decided to do. So they went to First Boston. First Boston in the late 70s was the leading M&A bank on Wall Street. And they said, look, we have 600 million in cash. Can you help us spend it? It's like walking into Bloomingdale's with 5,000 in cash saying, can you help me spend it? Of course, you're going to get a lot of help. And First Boston said, of course, we can help you. We'll find you the perfect target company. And they did. You know how much the target company was going to cost Kennecott? $600 million. It's amazing how the price of the target company magically converges on how much money you have on the balance sheet. You have 600 million, it's going to cost you exactly 600 million. And of course, if it's an acquisition, you got to justify the acquisition. And this was the cash flow table that the First Boston bankers used to justify paying 600 million. And they made a horrendously bad mistake. And I'm going to ask you to guess what the mistake is. And I'm going to lead you through how they computed cash flows. And then I'm going to ask you what discount rate to apply on those cash flows. So remember what we talked about, consistency. Here's how they estimated cash flows. They started with revenue, subtracted out expenses, subtracted out interest expenses to get to net income. And they added debt, added depreciation, subtracted out capital expenditures, and subtracted out debt payments to get to cash flows. I've already given you a sense of what they're doing, right? They subtracted interest expenses, they subtracted out debt payments to come up with. So what kind of, remember there are two ways you can estimate cash flows to firm or cash flows to equity. I want you to think about what kind of cash flows they've estimated, because now comes the key question. They've got the cash flows that they've estimated. The company that they were targeting was a company called Carborundum, a company that makes abrasives. They got those cash flows, and now you have to apply a discount rate to the cash flows. So I've described how the cash flows are computed. I'm going to give you 6 possible discount rates. One of them is right, the other 5 are the wrong ones. I want you to tell me what the right discount rate to apply on these cash flows is. I have a choice between discounting at the cost of equity or the cost of capital. I can use the acquiring company's cost of equity. After all, it's coming up with the money. I can use the target company's cost of equity, or I can use some melded cost of equity when the two companies are combined. So let's start with the easy choice first. Given how I've estimated cash flows, should I be discounting at the cost of equity or the cost of capital? Go ahead. You got a 50-50 shot and you got the wrong shot. So how did I get the cash flows? What did I say I did? I subtracted out interest payment and I subtracted out debt payments. When you subtract out cash flows to debt, what you're left with is a cash flow to equity. That's always a dead giveaway. When you see cash flows computed in there after interest expense and after debt payments, the cash flows are to equity. So the discount rate has to be a cost of equity. You can draw a red line through the cost of capital. None of those apply. Now comes the tricky question. And most M&A bankers get this question wrong. I would say 60 to 70% of the time. Whose cost of equity should I be using? The acquiring companies, the target companies, or a melded number? That's what most bankers do, and it is a horrifically bad mistake. And let's see why. Why is that? That's two is so basically by isolation, we come to the right answer. It's not the acquiring company, it's not the merged. So I'm going to put you on the spot. Tell me the intuition behind why it has to be the target company's cost of equity. Now we're on to something. This is the rule on discount rates. And remember this, and any time you have to use a discount rate. The discount rate on a set of cash flows should reflect the risk in the cash flows, not the risk of the entity looking at the cash flows. So if I gave you a set of guaranteed cash flows, you know what discount rate you should apply on them? I don't care who you are. They're guaranteed. What discount rate should you apply on them? You should just apply a risk-free rate, right? The rule in discounting is you always find the discount rate that best. So if you're a chemical company buying a tech company, for God's sakes, don't use a chemical company's cost of equity to value the tech company. One's got nothing to do with the other. The right discount rate should have been the target company's cost of equity, 16.5%. Now let me ask you a question. If you were going to pick the worst possible discount rate here, the most wrong you can get, is that even the right word? The wrongest you can get, the furthest away from the truth, which one would you pick?
Cannot, so the acquiring cost of capital.
You'd use the acquiring company's cost of capital. And guess what First Boston used? 10.5%, which is the acquiring company's cost of capital. You think, what difference can it make? You take those cash flows and discount them at 10.5% to 16.5%, you get $700 million, which justifies paying $600 million, right? If you take the exact same cash flows and discount them at the right discount rate, you come up with $450 million, in which case, what have you just convinced Kennecott to do? Pay $150 million more than they should have because you screwed up on the discount rate.
Or they purposely did that.
The question is, are they, because people assume investment bankers are clever. Let me dispense that delusion. You'd be amazed at how many screw-ups there are in valuations in investment banks. And here's why it happens. If you ever worked in an investment bank, there's a team of 5. You're given an artificial deadline. Don't ask me why. It's got to be done by midnight tonight. 11:30, you haven't slept in 3 days. Basically, you got to get the thing done. It's amazing in that last rush how numbers come together and how easy it is to screw up. I don't think they did. I think they just did not think it through. They thought about each line item separately, and probably 2 separate teams worked on it, one on the cash flows, one on the discount rate. They got together in the last 7 minutes. They put it together. You have a calamity. For this, First Boston got advisory fees. You could have asked your doorman, how much should you pay for this company? You'd probably have got better advice. What I'm trying to say is, don't be dazzled by the name on the top of a valuation report. It could be KKR, it could be Goldman Sachs, it could be McKinsey. Don't assume that people know what they're doing. Always check the numbers. And it's very simple. Check the cash flows. Are they before debt payments or after debt payments? What discount rate is being applied? Whose discount rate is being used? And you'd be surprised at how many valuations fail that very first test. So we're going to talk a lot more about consistency, but this is just the first layer. Any questions? So now let's move back to the introductory notes. I left you halfway through, right? I talked about discounted cash flow valuation. And remind me again, what kind of investor do you need to be able to use discounted cash flow valuation? In terms of time horizon, you need to be an investor with a long time horizon who has faith that the market will correct its mistakes over that long time horizon. It works best on assets where you can estimate the expected cash flows. Let's move to the second way you can put a number on a company, pricing. And let's think about what's different in this scenario. In pricing, you've given up on intrinsic value. You say, look, I don't know whether there's an intrinsic value. I'm going to try to come up with a number that reflects what other people are paying for similar assets. So philosophically, you've given up on intrinsic value. And if you look at pricing and you look at what goes into a pricing, then you'll see three things. First, you will see a standardized measure of the price because you can't compare price per share across companies. Why not? If I just base my looking at pricing at the price per share of companies, what's the most expensive stock in the US? Berkshire Hathaway, because it's what, $300,000 per share, $350,000. And a penny stock looks really cheap, right? That's absurd though, because price per share is in a sense arbitrary. It sounds like a strong word, but I'll give you an example of how quickly price per share can change. Last year, Tesla did a 5-for-1 stock split. You know, the minute after the stock split, what happens to the stock price? When you do a 5-for-1 stock split, what have you done? You've taken the same company, you've taken their existing shares and multiplied them by 5, right? The price per share dropped by roughly 80%. See, that's terrible. No, but you still have now five times as many shares. Price per share cannot be compared across companies because in a sense, it's a function of share count and how you come up with the share count. So we have to standardize price. What does that mean? You have to divide the price by something, price by earnings, price by book value. We're looking at the entire firm, enterprise value by EBITDA. Basically, that's what a standardized price, and you're going to see it in every price. Second, you got to come up with a group of assets that are similar to yours. I'll tell you a very simple way pricing works. It's been a long time since I've been to a sporting event, but I'm a Yankee fan, and when I lived in New York and I'd go to a Yankee game, I usually look for seats on SeatGeek. Have you tried SeatGeek? SeatGeek is one of those, it basically allows you to buy seats for a game, but the way it's set up is actually very interesting. It's an aggregator. So StubHub is on there. So all the Ticketmaster is on there, all the different. And what SeatGeek does is it takes all these different businesses that sell seats. And then when you look for a seat, it classifies seats into great deals, good deals, average deals, and bad deals. It's almost magical, right? You're saying, how did they do that? It's very simple. They take each section of Yankee Stadium. They look at all the seats that are being offered for sale in that section. And since they say all the seats in section 123 are pretty similar, they take the lowest price seat in that section. That becomes a great deal. The highest price becomes the worst deal. That's pure pricing. It's easy to do that with Yankee Stadium seats because you can do it by section. But if you try to do this with Microsoft already, you can see the question, right? How do you find 15 other companies that look just like Microsoft? The answer is you really cannot, but people stretch all the time. They say, I'll compare to other software companies, other tech companies. But in pricing, you have a standardized price. You have a group of companies or assets that you claim are very much like yours. And then you tell me a story. You say, what's the story got to do with it? Let's say you're valuing Tesla or pricing Tesla. So technically, Tesla is an automobile company, right? So if we compare Tesla to other automobile companies, Based on every single standardized price metric, what are you going to find? That it looks overpriced or underpriced? It's going to look massively overpriced based per car sold per versus earnings. But then what's the story you're going to tell me if you want me to buy Tesla? But that's okay because it has much higher growth than a typical automobile company. It's going to have much higher margin than a typical automobile company. That's a storytelling part. You pick up any equity research report on Wall Street, you're going to see a standardized price, a pricing multiple. You'll see a group of companies, the analyst claims are just like your company. And then the analyst will spin a story about this company, either making it a buy or a sell. Well, we can talk about whether it's a good pricing or a bad pricing, but let's think about the assumptions you have to make about markets for pricing to work for you as an investor, for you to make money. Remember in intrinsic valuation, we assume markets make mistakes. You can find those mistakes and the mistakes correct over time. In pricing, you assume that markets on average price companies right. That all software companies, across software companies, the market gets it right, but it makes mistakes on individual stocks. That's implicit in pricing because you're comparing across companies. And then you assume that those mistakes get corrected much more quickly because they're much more noticeable. So you're a steel company that trades at 5 times earnings and every other steel company trades at 15 times earnings. You stick out like a sore thumb. And the assumption is markets are going to notice and they're going to correct that mistake. You see the different assumption we're making about market mistakes. Market mistakes are not across time, they're cross-sectional. And corrections happen much more quickly because they're more noticeable. Remember I said you need a long time horizon for intrinsic valuation to work for you? Now do you see why 90% of people in markets use pricing? What's the time horizon of a typical mutual fund? You know how you can tell? There's something called a turnover ratio that tells you what percentage of what the trading volume of a mutual fund is relative to its holdings. So if your turnover ratio is 0, you never sell. There's no mutual fund out there with a turnover ratio 0. The average turnover ratio for a mutual fund is between 150 and 200%, which means that technically their time horizon about 6 months, maybe 7 months, 8 months. If your time horizon is 6 or 7 or 8 months, you can see why you're attracted to pricing more than discounted cash flow valuation. So what are the advantages of pricing? First, you are in sync with the market. Remember I said with intrinsic valuation, everything can look overvalued? Because technically there's no reason anything has to be undervalued because you're looking at cash flows, growth, and risk. In fact, the definition of a bubble is everything gets overvalued. And with intrinsic valuation, you're going to catch it. With pricing, 50% of stocks, roughly speaking, are going to look underpriced, and 50% are going to become overpriced. The reason is you're comparing to the average.
Hi, Professor. Real quick, I don't think the Zoom has the same slides as in class.
Let me try. You stop the share and retry it. Is that
perfect? Perfect.
So in pricing, you will always find underpriced, overpriced stocks. Why does that matter? If your job is to be a mutual fund manager, to invest in equities, you will always find things that are cheap enough with the pricing. So that's one of the advantages. It's going to become a disadvantage as well, as you'll see in the next slide, but that's one reason why portfolio managers like pricing. Second, if you look at how you do pricing, it requires far less explicit information. And I'm going to use that word, and you're going to see why I use the word explicit. Then you need to do valuation. The valuation, you got to pull up financial statements, you got to understand the business model, you got to make forecasts of cash flows, growth, and risk. Whereas you can just compare price earnings ratios across companies with far less effort, right? So at least on the face of it, you're saying pricing requires much less work than discounted cash flow valuation. I'm going to argue that surface level, but at least the surface, you can see again why analysts like pricing. It's a lot less work. And finally, if you're playing the game of what I call the incremental game, pricing may allow you to play on the next news story that comes up. Now, in the big, there are 4 big event dates for every publicly traded stock in the US. There are dates on which earnings reports come out. Apple's earnings report came out last week. Netflix came out 2 weeks ago. Let's say ahead of the Netflix earnings report, you came to the conclusion that the user numbers for Netflix were going to be lower than expected. You did your own research, and the earnings report is tomorrow. You don't even have to value the company, right? You can play a pricing game because you know that when that report comes out, people are going to sell the stock. It's got nothing to do with the stock being undervalued or overvalued. It's a momentum game. If your game is to play around information announcement and what I call the incremental game, pricing might be what works for you best. Let's talk about the disadvantages. In pricing, what are you concluding? That something looks cheap because it looks cheap relative to everything else, right? So you pick the cheapest AI company out there. You're probably going to base it on revenue multiples. This is the cheapest artificial intelligence company. But let's say that all of them are overpriced. Remember, markets can sometimes make mistakes on an entire group of stocks, all banks, all tech companies. All you've done is bought the least overpriced, overvalued company in this group. So your consolation price is you lose only 30%, everybody else loses 60%. That's a downside of pricing. You're not gauging what the value of something is. And if collectively markets make mistakes, you're going to be in trouble. And to the notion that you require less information to price companies, let me push back. What did I say were the 3 variables that drove value? Anybody remember? Cash flows, growth, and risk, right? Later, when we come back and talk about pricing in detail, I'm going to argue that embedded in every multiple, PE ratios, price to book, EV to EBITDA, are assumptions about cash flows, growth, and risk. The only difference is instead of being explicit about those assumptions, you're implicit. So you pay 50 times earnings for a company and ask you why. You say, it's got high growth. But then ask you how high, you haven't even thought about that. Just the high growth explains it. The difference between pricing and valuation is not that you're making fewer assumptions, it's that you're not being explicit about your assumptions. I think that's a very dangerous place to be personally, but that's what happens in pricing. People justify a high pricing or a low pricing by pointing to one of the factors, but not fleshing out the details about what the growth rate is or what the risk is or what the cash flows are. So pricing has its advantages and disadvantages, but for a subgroup of people, especially portfolio managers who get judged relative to other portfolio managers, you can see why pricing is the preferred choice over intrinsic valuation. So when is pricing easiest? Is when you can find other assets that look just like your asset. It's easier to price a company when there are 15 other companies, utilities in the US, for instance. It's pretty easy to price because there isn't that much difference across utilities. They all are low growth and low risk. Pricing a utility is pretty straightforward. Pricing a REIT, real estate investment trust in the US, it's pretty straightforward. You know why? What are all REITs required to do? You know what a REIT is? It's real estate investment trust. There are 2 ways you can actually organize a real estate business. One is as a real estate corporation. The other is as a real estate investment trust. What's the big difference? What do you gain and lose as a real estate investment trust as opposed to real estate corporation? Anybody want to know? Yes.
As a real estate investment trust, you don't have to pay corporate taxes.
This is great, right? No corporate taxes, but in return for giving you that benefit, you have to pay out 90% of your earnings as dividends. The IRS gets you one way or the other. You know why? Because they say you don't have to pay tax. Oh, by the way, you have to pay 90% of your earnings as dividends. When those dividends go into people's accounts, they get taxed on their individual tax rate. So REITs, though, are pretty similar because they're all structured. So when you price a REIT or you price a utility, you have an easy job. But I just gave you the example of Tesla. You know what makes Tesla so difficult to price? There isn't another automobile company in the world that's remotely close to Tesla. The traditional auto companies all have legacy problems. They all produce gas cars for the most part, even if they have an electric car component. You're saying, why can't I compare Tesla to Rivian and Lucid and NIO? You have a different problem, right? Tesla sold 500,000 cars last year. It is a company now of some substance. It actually is selling cars. It has revenues. It has... Most of these other electric car companies are kind of startup companies. They really haven't sold more than a few thousand cars. Tesla is a really difficult company to price because A, looking across the automobile space, you can't find comparable companies. And there are some people who argue that Tesla should not be priced against other automobile companies. It's really a tech company. It's kind of a stretch of the word tech that it should be compared to Facebook and Amazon and Netflix and Google. It's not wrong. It's just a different way of thinking about pricing, but you can see why some companies are more difficult to price than others. And if you think about what kinds of investors this pricing works for best, it's investors with shorter time horizons who are judged based upon a relative benchmark. You know what I mean by that? Remember I said when you buy a stock that looks underpriced, all you're getting is the least overvalued company in a sector. You might lose only 30% when everybody else loses 60%. You think that's terrible? Not if you're a mutual fund manager. Because you know how you get judged as a mutual fund manager? You don't get judged on absolute performance. You get judged on relative performance. If you get a chance, visit Morningstar and Lipper, both of which rank mutual funds. They don't look at what your total return is. They look at your return relative to other mutual fund managers in the same group. And finally, there is a group of investors for whom pricing works because they can play both sides of the pricing divide. Let me explain. Most mutual funds in the US can be long only. They can only buy. They're not allowed to sell short. So if you find something underpriced, you can buy the underpriced security and hope the pricing corrects. Hedge funds, though, can go long and short. Do you see how this is an advantage in the pricing game? So here's what you do. You buy the underpriced, you sell the overpriced, and you get down on your knees and hope and pray that they all get correctly priced, because then you get benefits on both sides, right? The underpriced go up, you make money on your longs, the overpriced come down. Of course, you could be terribly wrong about the pricing correcting, but it works better for those people who can take advantage of mistakes on both sides. What I'm trying to say is don't get into absolutes. Don't tell people, look, valuation is the right thing, pricing is terrible, because it depends on who you are, what your mission is, and how you get judged. And it doesn't surprise me in the least that most mutual funds and most portfolio managers are bigger believers in pricing than in intrinsic valuation. I've talked off and on about Bitcoin and cryptos. I'm going to set up a table, which I hope will give you some clarity into valuation and pricing. If I come to you with an asset, publicly traded company, a business, you can both value the company and price the company, right? To value the company, you'd have to figure out what the business model does, what cash flows it generates, take the present value. So if I gave you Apple, you can value Apple, you can price Apple. If I gave you a commodity, say oil, it's very difficult to value oil. You'd have to figure out some demand and supply, and even then you have all this noise in the process. Most commodities get priced. There's really no intrinsic value to it, or it's very difficult to get. If I give you a currency, the only thing you can do is price it. Currencies cannot be valued. I think I mentioned this in the first class. They can be priced against each other. And finally, if I give you a collectible, a baseball card, a Picasso, only thing you can do is price it. There is no intrinsic value to it. Knowing whether you can value something is a huge part of getting investing right. Because I've seen people try to value Bitcoin. They go through these contortions and they say, what the heck are you doing? I'm trying to value Bitcoin. It cannot be done. Let me save you the trouble. It can be priced. You can tell me whether it's correctly priced or not. But here's the other aspect of valuation. When you have something that can be both valued and priced, there's a floor and a ceiling to what that number can be. So with Apple, we can debate whether the share should be worth $100 per share or $400 per share, but there are limits because there is an underlying value. If something can only be priced, there's no upper limit, and there might not even be a lower limit. So you ask me what's the highest price that Bitcoin can go to? My answer is I have no idea. If there's enough momentum, it could be 150,000, it could be 200,000, it could be 250,000. You ask me what's the lowest price it can go to? Normally, what's the answer you'd give? I used to think that this was the floor and the price. What's the lowest price you can have? Zero. Until in April of 2020, I saw what happened to oil prices. You know what happened to oil prices in April of 2020? It went to minus $32 a barrel. Pricing is unconstrained, value is constrained. And if you have something that can only be priced, you're going to get much wider swings because there's nothing, no anchor holding it together. So when you see Bitcoin swinging all over the place, it's not a bad thing or a good thing. It's the nature of something that can only be priced. Yes.
But oil could be valued. Isn't the reason oil went negative because its value went negative?
It's not so. The storage cost was why it went negative. It can't be valued unless you want to build a model, a macro model of demand for oil and supply for oil. That's why I said for commodities, there's perhaps a macro model that you can build. I have never found one that actually works because there are too many things that are out of your control. But it's true, some commodities you can come up with a value if you're willing to build a macro model. It's got to be a global demand for oil and global supply. Now, but for the most part, people just price it. So you got talked about intrinsic valuation, we talked about pricing. Let's take a little tangent here. People often ask, what about asset-based valuation? In particular, they talk about things like liquidation valuation or sum of the parts valuation. You know what sum of the parts valuation is? You have a multi-business company like United Technologies or GE. What you do is instead of valuing the company, you value each part of the company separately. So United Technology owns Otis Elevators, you value that. Sikorsky Helicopters, you value that. So each part of the business, and then you add up those values. It's called a sum of the part valuation. Saying, why isn't that a different way of valuing companies? Let me ask you a question. If you have to do a liquidation valuation, you got to come up with a number for each asset you own, right? The land, the equipment. How do you come up with that number? What are the two ways you can come up with that number? You can either do an intrinsic valuation or you can do a pricing. You see where I'm going? When people talk about asset-based valuation or liquidation valuation is a different way of thinking about value, say not really. You got to decide then, are you going to do a pricing of each part of the company or a valuation? In fact, with United Technologies, I'll do a sum of the parts valuation and a sum of the parts pricing. So you can see the two approaches play out. But ultimately, my point is intrinsic valuation or pricing, pick your poison. That's probably the wrong word to use, but pick your choice and then kind of stick with it. Because there's nothing good or bad about each, but each brings its own advantages and disadvantages. So I'm going to ask you a question, and then at the end of this class, I'm going to revisit this question. Because by the end of this class, you'd have had your chance to value companies and price companies. So based on where you are right now, what you know so far, what you've tried so far, if I asked you to pick a way of putting a number in a company, would you pick intrinsic valuation or a discounted cash flow valuation? Do you think pricing is a better way to do it? At the moment, you don't think either is going to work because you believe markets are efficient. Okay, ready for a show of hands? How many would pick intrinsic valuation based on what you know? So a lot of selling to do because most of you don't look like you're true believers yet. Right? How many think pricing is a much simpler, more straightforward? And I'll assume the rest of you are kind of holding your fire saying, I'm not even sure why I'm in this class. I just need the credit. That's which is fine, right? I want you to keep that in mind as you go through this process because your perceptions of both are going to change as you try them out on real companies. One final point, and this is the third and final approach to approaching value. There are some assets where neither discounted cash flow valuation nor pricing gives you a fair number for the asset. Why? Because the cash flows are contingent on something happening. I gave you the example of an oil company with reserves that are not viable, or a pharmaceutical company with a patent that's working its way through the approval process. What's the contingency? With the oil companies, if oil prices go high enough, the company could be worth a lot, and if they don't, the oil reserves are worth nothing. And with the pharmaceutical company, if you get approval, it could be $1 billion drug, and if you don't, it crashes and burns. Those are options. And you can use an option pricing model to value the options, but you start with the discounted cash flow valuation. So when we talk about valuing a patent as an option, we'll start with the discounted cash flow valuation. And what the option will do is give you a premium on top of that value because you believe that that optionality could potentially pay off in the future. So for the moment, that's all I want you to think about, because I don't know how much you did options in foundations, but if you think about what is it that makes an option, it's very simple. I think there are two kinds of options, call options and put options. Call options give you the right to buy at a fixed price. Put options give you the right to sell at a fixed price. But we cut through all the BS. Here's what makes options different from any other type of asset. Take a call option. You got limited losses and potentially unlimited profits. Why? Because you can't lose more than what you paid for the call option. With a put option, you have limited losses if the price goes up, and potentially not unlimited profits because the price can't go below zero, but huge profits. In other words, your losses and options are limited, but your profits are potentially huge. You know how this plays out? When you buy an asset that's primarily an option, risk becomes your ally. And here's why. Normally, when you buy a traditional asset, you don't like risk. Why? Because risk hurts you, right? It can hurt you, it can help you, it cuts in both directions. What have I done with options? What type of risk do you not like? Upside risk or downside risk? Yeah. Nobody complains about their stock going up 85%. Oh my God, I feel terrible. My stock went up 85%. What have I done with options? I've restricted your downside risk. You know what that means? When you're valuing an asset that's primarily an option, risk becomes a good thing. So when you value an oil company with undeveloped reserves, you want oil prices to be much more volatile. When you buy a technology company with a patent that's not viable, you want much more uncertainty in this business because that uncertainty is what's going to make this patent potentially valuable in the future. So I'm not going to waste my time in this class using option pricing to value traditional options, listed options, convertible bonds. There are other classes you can get that. This class, when we talk about option pricing, it's going to be in the context of valuing certain kinds of businesses. So you're going to see me use option pricing to value oil companies. You're going to see me use option pricing to value a pharmaceutical company. You're going to see me use option pricing to value equity in a deeply troubled company. You know why? What's the lowest price your stock price? What's the lowest your stock price can go to? Zero. You can't go below zero. There's an optionality when you buy equity in a publicly traded company, which makes equity in a deeply distressed company behave like an option. So that's why you're going to see option pricing, not in the more traditional setup. Now, just truth in advertising. Most of what we know in option pricing models was designed to value listed options on the Chicago Board of Options. You think, so what? You know what the maximum maturity for an option on the CBOE is? Anybody know? It's about, I think, 6 months. You can't go above 6 months. In other words, option pricing models, as we know them, were designed to value options on listed stocks and on short-term options. Many of the options we're going to talk about, where we talk about valuing a patent or valuing undeveloped reserves, we're taking long-term options where the underlying asset is not traded. In other words, the patent is not traded, the oil is not traded. We're stretching the limits of option pricing models. And when I use option pricing models, as I will, I'll be open about this. I came up with the value for this option, but don't trust it too much. There's a big range on it because I'm pushing the limits of option pricing. So I don't think of option pricing as something magical, but it's something that's good to have in your arsenal for those companies where you think traditional discounted cash flow valuation is understating the value. So in terms of disadvantages, that's really what you're going to factor in. Because the advantage is you can now attach a number to companies people give up on. If I gave you a distressed company, traditional discounted cash flow valuation, the equity is worth nothing. Using pricing, you come up with the same conclusion, but there is an optionality that will let you come up with a number. But the disadvantage is you're pushing the limits of models that were never designed for this type of option. So I'll spend about 30 minutes kind of reviewing option pricing models, because I think most people have forgotten Black-Scholes, binomial, but you need at least a working knowledge of those, and then use those models with the full knowledge that those models give us very imperfect estimates of numbers, but at least we're getting an estimate. So intrinsic valuation, pricing, real options. Every valuation model that you will see out there has to fall into one of those three buckets. Next time you see a valuation of a company, just first make sure it's a valuation, not a pricing. 9 times out of 10, it's going to be a pricing, because the analysts have used price earnings ratios in 15 companies. Perfectly okay. You're not going to jump down his throat, but you shouldn't use the word valuation. When people talk about it is a premium for the platform that this company has. Now, I heard this argument for Peloton. The business doesn't look good, but it's built a platform of loyal users. That's true, right? And they say we should pay a premium. They're using an options argument. What I'm suggesting is next time you read something on valuation, do it as an informed consumer, because now that you know the difference in valuation pricing and how real options can play out, you can be the judge on whether people are using the right terminology or whether they're mixing and matching things they shouldn't be. Any questions on that introductory section? Okay, I'm going to open up the first packet here. Do the screen share again. So now we're into packet 1. If you haven't downloaded it yet, please do it at the end of today, because from this through almost midway through the class, this is the packet that's going to drive our class. So let's start by a very quick review. Discounted cash flow valuation, what are you trying to do? You're trying to value an asset based on its cash flows, growth, and risk. Discounted cash flow valuation is the most common form of intrinsic valuation, but it's not the only one. So let's dig a little deeper. Okay? When you think about doing a discounted cash flow valuation, I'll go with the more common way you'll probably see it presented. You take expected cash flows on an asset. Keyword is expected because things can change. You take your expected cash flows and you discount those expected cash flows at a risk-adjusted discount rate. It's typical discounted cash flow valuation. So riskier businesses have higher discount rates, but for both, use expected cash flows. Notice that you don't use conservative cash flows. You don't use aggressive cash flows. So that's why you should be careful when people say, have you done a conservative valuation? No, valuation is supposed to be about expected values for the cash flows, the risk-adjusted discount rate. So the discount rate carries all of the load of conveying the risk in the valuation. There's another way you can do valuation that's a little more, it's very uncommon, but I'll give it to you anyway. Rather than having the discount rate be the mechanism for adjusting risk, what if you adjusted the cash flows for the risk? It's a little more complicated than it sounds. It's called a certainty equivalent cash flow. So let's take an example. You're going to be my lab experiment here. Let's assume that I have an investment which has a 20% chance of making $500,000 next year and an 80% chance of making nothing. Everybody clear on what the cash flows are? 20% chance of $500,000, 80% chance of nothing. How much would you pay for that investment today? He said 100,000, but the reason that is dangerous is, let's suppose I now gave you a choice between getting 100% guaranteed and this investment. Would you value them the same? You see what I'm saying? One is this 20% chance of 500,000, 80% chance of nothing. The other is a guaranteed 100,000. I would say most human beings would pick the guaranteed 100,000 over the expected value of 100,000. Why? Because human beings are naturally risk averse. Have you ever seen the show called Let's Make a Deal with Howie Mandel? If you get a chance, watch the show, because here's what it is. You have these suitcases on a big stage with, which could have $1 million, could have nothing. And at every stage, this is the game that Howie Mandel plays. Do you want to take $250,000 guaranteed, or do you want to take your bets on what's in the suitcase where you could get nothing or $1 million? And take a look at what people settle for. the investment that I just offered, they might say, I'll take 60,000 guaranteed instead of this risky investment. That doesn't make you irrational, it just makes you human. You're risk averse. Certainty equivalent cash flows, that's what you're doing. You take the expected cash flows on a business and you take each expected cash flow and replace it with what you would take as a certainty equivalent guarantee. So if you have an expected cash flow of 100 million, it's very risky. You would say, if you give me 50 million, that's fine. I'll take the 50 million. Because you've adjusted the cash flows for your risk, you know what discount rate you need to apply on these cash flows? The risk-free rate. Now, often one of my biggest challenges when I teach this class is people listen with half a year to what Warren Buffett is saying. And then they insist that that's the right way to do it. And one of the things that Buffett has said before is he doesn't use risk-adjusted discount rates, that he uses one discount rate across the board, often very close to a risk-free rate. And people say, well, if that's good enough for Buffett, and look at how rich he is, why are we risk adjusting the cash flow? What they miss is the other half of what Buffett does. When Buffett looks at a company, rather than looking at expected earnings, he counts only that portion of the earnings that he feels are secure and close to guarantee. He never uses the word certainty equivalent, but he is doing his own version of certainty equivalence. So if that's what you're doing and you're adjusting the discount, using a discount rate close to risk-free rate, I don't have a problem with it. The only thing is you have to be careful about making sure that you are in fact adjusting the expected cash flows down for the risk aversion. 99% of valuations you're going to see, I'm going to take the first form, but one of the more troubling things in discounted cash flow valuation is when people use conservative estimates for the cash flows. What are they doing? They're actually adjusting the cash flows for risk, bringing them down, and then proceeding to use a risk-adjusted discount rate. There's a danger of double counting. Don't play games. Get the expected cash flows, no matter how uncertain they are. Let the discount rate carry the weight, and that will take care of the risk in your asset. So I'm going to do something that it's, again, an experiment that I find useful in bringing home what drives value. Now, often when I value companies on my blog, I get pushback, especially when I pick a company like Tesla to value. Incidentally, that's going to be a valuation of the week this week. Is my November 2021 valuation of Tesla with my blog post and the spreadsheet, and you can value Tesla on your own. And when people don't like the value that I attach to a company, one of the critiques I hear is I'm a theorist. And I have to laugh because I know exactly how little theory there is in my class. You want to see the entire theory for this class? It's one equation. That's it. That's my entire theory. The value of an asset is the present value of the expected cash flows. But that's a very powerful equation, and I'm going to use it to kind of bring home 4 basic propositions about valuation. And I need somebody to be my guinea pig for this game. You want to be my guinea pig? Because they're in the front row. So here's what I have. I have an envelope, nothing in it. I have a $20 bill. I'm putting $20 into the envelope. I'm not a magician. See, my sleeves are all rolled up in there. Okay. How much would you pay for this envelope?
$20 or anything less?
You can't have it both ways. Is it $20 or something less? I'm glad you said that, because most people, when they see me put $20, offer me $20. And if you pay $20 for an envelope with $20 in it, what do you get out of this transaction? An envelope, which I stole from upstairs. It's not even my envelope. First rule in valuation, if you know the value of something, don't start your bidding at that number. Start with a lower number. Unless you're a banker, in which case you break all the rules, you go with a higher number, do whatever you want. But now we're going to make this game interesting. I want you to read to the class what this says.
Control.
Control. Remember the envelope at $20, we'd valued it at $20. I've added control to the envelope. How much would you pay for this envelope? It now has control in it.
You're up.
At least, pay me at least 20. There's a $20 bill with the control.
$20 bill. Anything below 20.
So your value stayed at 20, right? Control, isn't that worth something? You know why I picked the word control? Have any of you worked at the M&A groups of banks? What happens when you do an acquisition? What's the rule that bankers often do? They value a company and add 20% premium for control. The premium. I actually tried this on I was asked to do this for a group of M&A bankers at Goldman Sachs. These are seasoned bankers, which means they're older, they'd forgotten everything they should have learned along the way. So I said, "Now, how much do you pay?" And one of them decides to be clever. He says, "I'll pay $25." You know what I did? I sold him the envelope. In which case, what has he just done? He paid $5 for a 3x5 card that said control, which cost me absolutely nothing to write. You can see where this is going next. What does it say?
Brand name.
Brand name, big deal. I'll put that in there too. How much should you pay for that now? How about this? ESG, I'll add that too. Sustainability, I'll put that in there. I call these weapons of mass distraction. You know why I call them weapons of mass distraction? Because they show up after you value the company because they want you to add a premium. What about control? What about this? What about that? I wrote a post on these words that I call weapons of mass distraction. I'll send you the link to it in my email today. And I put in what I call my two keywords if you really want to push up the value of something. One doesn't work as well as it used to, but the first one still works. You're trying to value a company, or you're trying to sell a company. You valued it at 100 million. You want somebody to pay 150 million for the company. Try this word, it usually works. Strategic. Strategic is a classic weapon of mass distraction. For the longest time, there was another word that worked, especially in the US and Europe. You value a company, you valued 100 million. You got this very canny buyers refusing to pay a premium. Throw in this word, China. It's amazing what it does in terms of adding zeros at the end of the billion people just goes to people's heads. I still remember when Alibaba went public. And I was on CNBC and they paired me with this equity research analyst who was very bullish in Alibaba. I liked Alibaba, but not as bullish as this guy. So I'd done a valuation of Alibaba and said, this is what I did. And they asked the analyst, why do you think Alibaba is worth more? You know what he said?
China.
It's in China. I said, really? That's all you need? It's extreme laziness. But this is what happens when you let these macro stories kick in. Why should I buy an electric car company? Because everybody's going to have an electric car. So I'm going to state a proposition that I call the IT proposition. It's an extraordinarily powerful proposition. And here's what it says. If it does not affect the cash flows and it does not affect the risk, it cannot affect value. You're saying, what's it? You name it. Conversely, if you tell me something affects value, I'm going to put you on the spot. So tell me how it affects the cash flows and how it affects risk. In fact, let's take a couple of the words I threw in as weapons of mass distraction. What is the true value of control? You want to try, what's the value of controlling something? What do you do?
I'm not sure about that.
You get to. Synergy is almost a different buzzword. So let's put that to the side. With control, you get to run the company instead of the existing management, right? And you could do things differently. So if you take Peloton, there are a lot of people who are dumping on Peloton. The management seems to be doing a terrible job. Let's say I give you control of Peloton. You're going to make it a subscription-only business. Forget this fitness equipment thing. You think it's a loser. And let's say you're right. You know what I'm going to get? I'm going to get two values for Peloton. One with the existing management running it, and once with you running it. And presumably what you're doing is better for the company. I should get a higher value. That difference is the value of control. You know the implication of this is, right? If you have a company that's already perfectly managed and perfectly run, what should the value of control be at that company? Zero. we have a company that's abysmally run, it should be huge. It could be 100%. Who comes up with this crap, 20% control premium? And why does it apply for all companies? So I'm not saying control doesn't have value or brand name doesn't have value. We're going to value Coca-Cola's brand name, but we're going to do it right by finding the place in the cash flows and the risk where it's going to show up and valuing what that brand name is doing for the company. What's the value of a company being in China? It's a huge market. I'm going to give it the benefits of a huge market, but I'm also going to bring in the considerations of, hey, what are the margins going to look like? It's my job to go beyond just the weapon of mass distraction, say, let's see it play out in the cash flows in this country. Obviously more work, but think of how much sloppiness there is in this process if I just let you add a zero because it's a Chinese company. Second proposition, called the don't be a wuss proposition. Okay. Basically, when you have to value a company, you have to make estimates. And some of you are going to bitch and moan to me about how uncertain you feel. Save me the emails. Don't even send it to me. Because we all have that problem. It's not like there's somebody with a crystal ball who knows exactly what's going to happen to Peloton or Spotify. We have to make our best estimates, and we're going to be wrong 100% of the time. And that's okay because everybody's in the same boat. Third proposition is called the DER proposition. Let's say you sit down to value a company. You project out cash flows, they're negative next year. Project out cash flows 2 years from now, it's negative 2 years from now. 3 years from now, negative again. In fact, this company is such a terrible business model that you don't think it'll ever make money. How much should you pay for this company? It's a trick question. How much should you pay for a company that has negative cash flows forever? What's wrong with you? Why are you paying for a company with negative cash flows? They should be paying you, right? When a company has negative cash flows, as far as the eye can see, the company is worth nothing. Walk away. But let's make this proposition more interesting. Let's say you sit down to value a company. Your cash flows are negative in year 1, negative in year 2, negative in year 3. But then the business model starts to pay off. The economies of scale kick in, which is what you're going to see in any good growth company, right? If you take a Peloton, their cash flows right now are negative, no matter what you think about the company. But if you believe their business model is going to pay off eventually, the cash flows will turn positive. This company could still be a really valuable company if the cash flows you're going to get in the future are disproportionately large positive cash flows relative to the cash flows they're losing upfront. See why they have to be disproportionately large? If you lose $1 billion in year 1, you got to make $5 billion in year 10 to make up for it because you got time, value, and risk working against you. We're going to value a lot of young growth companies in this class, and you're going to see this phenomenon play out over and over. You're going to see negative cash flows up front. It's called cash burn. VCs freak out, they wring their hands, but it's a feature, not a bug. That's what you'd expect in a young growth company. But if it's got a decent business model with economies of scale, the earnings will turn positive, the cash flows will turn positive, and this company can still be a valuable company. So now let me go back to where I started today's class. I said there were 2 ways you can value a business. You can focus on the equity, value just the equity in the business. The other is to value the whole business and to subtract out debt. You say, which one should I pick? For the moment, I want you to keep both choices available, because later in the class, we'll talk about why one approach might be more flexible and give you more degrees of freedom than the other. But as I said, the end game here should be the same with both approaches as long as you stay consistent. So the risk of repeating the first 2 slides, let me repeat them. If you're focused on equity, here's what you do. Look at the cash flows left over after debt payments and reinvestment. You discount them back at a rate of return equity investors demand, and you value the equity in a business. Dividend discount model is a special case of an equity valuation model. But even if you don't buy into the dividend discount model, you can estimate the cash flows you could have paid out as dividends. It's called free cash flow to equity, but it's potential dividends, but you're focused on just the equity. Alternatively, you can try to value the whole business. Lenders and equity investors are both capital providers. One gets cash flows in the form of interest and principal payments. The other gets cash flows as whatever's left over. You add the 2 cash flows up. You discount those collective cash flows back at the cost of capital, you get the value of the entire business. Subtract out the debt, you come up with the value of equity. Now, one of the challenges you face when you use that second approach is what to subtract out. Because you value the firm, you're saying, what do I need to subtract out to get to the value of equity? And I'll give you the choices, and you tell me what you would subtract out from the value of the business to get to the value of equity. You can subtract out the value of just long-term debt. You can subtract out the value of all debt. You can subtract the value of any debt that you included as debt in your cost of capital. Because remember, you had to make a debt judgment there. Or you have to subtract out the value of all liabilities, which is, accounts payable, supply, credit, all of that stuff. Let's start with the one thing you shouldn't subtract out. What's the one choice here that you should never use? Never subtract out value of all liabilities. It's almost non-starter. I'll give you the overriding principle that's going to answer the other two questions. Whatever you included as debt in your cost of capital will also be the debt you subtract out to get the value of the equity. So if you define debt as only long-term debt, which I think is a horrifically bad mistake in your cost of capital calculation, you subtract out only long-term debt. I'm going to argue that the better way to compute cost of capital is to include total debt, and total debt to me includes long-term debt, short-term debt, but I'm also going to include things like lease commitments that might not make the past to be debt, but should still be considered debt. But make your choice on debt when you do your cost of capital right, and that's exactly the debt you should be subtracting out to get the value of equity. Now, I've given away the answer to the next question, which is, if you value the firm and you subtract out the right amount of debt, what value will you get for the equity? You should get exactly the same value for equity that you'd have got if you'd taken equity cash flows and discounted them back at the cost of equity. So I'm going to take a concocted example and show you how this plays out. It's concocted, and this week's weekly challenge is going to make you dig a little deeper as to what the concoction was. I know we haven't done discounted cash flow valuation, so take these numbers as kind of coming out of nowhere. You give me a company to value, I estimate cash flows to equity. So these are cash flows left over after debt payments. And if you add back the interest expense net of taxes, you have cash flow to the firm. So notice the cash flow to equity is always lower than the cash flow to the firm because you're looking at just what equity investors get. I'm going to compute both types of discount rates here. I'm going to compute a cost of equity, 13.625%. But I'm also going to give you the ingredients you need for the cost of capital by telling you that your debt costs you 10% pre-tax. Remember, debt does have that tax advantage, and that you face a 50% tax rate. I also gave you the market values of equity and debt. Why do you need that? If I give you cost of equity and cost of debt, to get to cost of capital, what do you need to do? You need to take a weighted average. I've given you the ingredients of the weighted average. So you ready? Let's take the two ways in which you can do valuation here. First is you can take cash flows to equity and discount them back at the cost of equity. What you get as a present value is 1,073 million. That's the value of equity. You're done. The second approach, you can take cash flow. First, you can compute the cost of capital, weighted average of your cost of equity and your after-tax cost of debt, much lower discount rate, much higher cash flows. What you get as a present value, though, is the value of the entire firm, 1.873 billion. You subtract out the 800 million debt. Magical, we get the same value for equity. As I said, I've cheated along the way here. I've concocted this example to deliver the same results. But this is good news in many ways, because it says, look, when you sit down to do valuation, make your choice up front. Are you going to value just the equity? Or are you going to value the entire firm? Because as long as you stay consistent, they should lead you to the same end conclusion. Now, how could you screw up? You saw what First Boston did, right? What did they do? They took cash flows to equity. They discounted the cost of capital. They were so confused. They had no idea what they'd done. So they didn't even subtract out debt. Conversely, you can take cash flow to the firm. So anytime you mix and match cash flows and discount rates, it's a deadly sin. There are layers of sins in valuation. I don't know how many of you are Catholic, but in a sense, I'm not Catholic, my wife is. But you can commit sins that you can confess to, and you said 10 Hail Marys and you're okay. Other sins, you're just done. Don't even try, you're beyond redemption. This is a sin beyond redemption. You mix and match cash flows and discount rates. You committed a sin from which there's no digging out. These are the kinds of mistakes that'll cost billions of dollars. You'll be off by hundreds of millions or billions of dollars in your valuation, as First in Boston was in their valuation. So don't mix and match. In fact, I've listed, put a big X on this page. So on the quiz, you don't end up on this page thinking this is what you're supposed to do. I've taken 3 possible mistakes. One is to do what First Boston did. Discount cash flow to equity at the cost of capital. You're going to overvalue the company. The second is discount cash flow at the cost of equity. You're going to undervalue the company because you use too high a discount rate on the cash flows, you use the cost of equity. And the third approach, you just forget to subtract our debt. Don't ask me how that happens, but all kinds of things happen when you have no idea what you're discounting and what the end value is. So think a little bit more. I know it's a little convoluted, but I want you to think about not all cash flows are made equal. You got to figure out what's the difference between cash flow to equity and cash flow to the firm. What the difference between cost of equity and cost of capital. They get used as cash flows and discount rate, but you have to make sure you're matching up, right? Otherwise, the end game is going to be out of hands. So next class, when we start, we're going to start by looking at big picture valuations, how the different pieces play. And then we're going to talk about risk-free rates, risk premium betas. We're going to get into the nuts and bolts of valuation.